right, brothers. We have made our return to YouTube. At least I hope. I don't know, bro. But today, I did promise a lot of people I would make a video about my last trading month. The caption of this video was going to be, I took 60K in payouts in 5 weeks. But the month in question, I did 45K in payouts. I'm just going to add the extra weeks, make it sound a little cool. But yeah, so this video, that's what this video is about to be. Like I said, man, I don't know if this is a full-time return to YouTube. It's just, I don't know, man. You know what I'm saying? I love you guys. I really do. But content literally does nothing for me. So what you need to know is that if I do make YouTube videos, it is purely from the kindness of my heart. YouTube doesn't pay me because my ad stuff is messed up. And like I said, outside of that, content doesn't really help me. I guess my businesses. So if I make a backtesting video, it's also because I love you guys, but it's also because it's gonna help promote my company, obviously. But videos like this are purely out of the kindness of my heart. It's purely because I love you guys, okay? So keep that in mind. Let's get into the video. And try not to touch yourself. We're trying to learn here.
Alright guys, it wouldn't be a strategy payout video if I didn't show you the payouts. I don't remember if I said this in the intro or not. I recorded that last night. If you guys don't know, I've already recorded this video. The audio wasn't on. I talked for 45 minutes straight. Yeah! Anyways, but yeah, the title of this video is probably going to be something like, oh, the strategy that got me 65K in payouts in 5 weeks. Something along those lines, right? You got baited. This isn't going to be a strategy video. I think strategy videos are retarded. But what it is going to be is I am going to show you some, like, what I think is the most important thing with technicals, like on the charts, that can help with just being a little bit more consistent. And then some psychology things too. Some of the stuff is like specific to funded accounts. Some of the stuff is just like general overall trading, okay? But nonetheless, we have to show the payouts because it is a payout video. So I moved to the new dashboard on the 27th. I'm gonna be honest, I didn't do the math on any of this. I have no idea if it's actually 5 weeks or not. I'm just throwing numbers out there that sound good because it should be around that range. So if I'm wrong, punch me in the balls, bro. But yeah. Well, the payouts should add up to 65K before splits. I'm pretty certain about that because I did the math for a TikTok video. It was 45K, or it was 44K before I took this payout, and this payout adds up to 22.5. So it's actually almost 67K in payouts requested, and then after splits and costs for funded accounts, it's probably somewhere around like 60K or like 61K. Somewhere around there. I don't know. I'm not going to do the math. You guys do the math. That's not my job. Okay? But yeah, so those are the payouts. You can look through them. You can add it up. You can do whatever you want. It was 2 sets of accounts. So, obviously, the first. Or was it 2 or was it? Yeah, it was 2. So the first two sets of payouts that were requested on one set of accounts, and the last 3 were requested on another set of accounts. And now I don't have any more funded accounts. I'm switching to AMP. I'm going back to trading with a live broker just because I think it just makes sense. I'm going to be putting a lot more money than I used to, so I just think now it's at a point where like the amount of money I'm going to put in, it should make sense, and I should make the same amount of money or more than I would from funded accounts. So that's what we're doing now. But yeah, there's the payouts, man. So let's get on the charts and let's start talking about some stuff that's going to help you get your first payout, right? Let's do it. That was good. Good shit, more trades. All right, man. We're going to start off with the technicals because I know you guys have brain rot and you don't really care about psychology. So we're going to talk about the stuff that you guys care about first, which is like candlestick stuff, strategy stuff. But yeah, man, let's get into it. I have 2 each. I've thought this out thoroughly. I think the 2 things that I'm about to mention are the 2 things that are the most important in each section. So the 2 most important for technicals and 2 most important for psychology. So let's get into it, bro. First things first, okay? The question, unironically, I think this is the question I get asked the most often, is how I find my bias and how I find like my drawn liquidity. I know I've dropped YouTube videos in the past and stuff like that, but I've evolved, bro. The way that I find my bias, the way that I do a lot of things now is way more simple than it used to be, okay? Let me take a sip of this, 1 second. Oh, I'm not gonna lie. Try drinking stuff with your mouth like wide open. Bro, I swear it tastes better. Those who know, watch. Like that first sip was gas. All right. Anyways. Ooh. Okay. The two things that we're going to talk about are how to find buys and draw liquidity and things that can help with finding good execution. So basically, execution-wise, I'm just going to show what I think qualifies every trade as an A-plus trade. So it doesn't have to be... Is there something on my neck? Oh, it's on my computer screen. So it doesn't have to be strategy-specific. It can be applied to any strategy and probably help you find better trades. And then, yeah, talking about bias. So the way that I find bias is I trade trend lines. Oh, Darius, you're a loser. Who trades trend lines? Oh, you're such a retail trader. I'm about to blow your mind here, okay? Just watch and learn. Stupid little... Ooh. I almost dropped one on you. I wonder if YouTube would ban me if I said, like, foul language like that. Anyways. So basically what I use is trends on the high time frame, but I don't just look at the trends and I'm like, oh, we got to make higher highs and higher lows. No, I know exactly where I want us to make higher lows, and I can sometimes target that point on the trend, okay? So basically, when it comes to my bias, it's so simple and it's so easy because there's only two options, okay? We are either trading into a high time frame gap after taking a high. This is specifically for an uptrend. We are either trading into a high time frame gap after taking a high, or we are inside of a high time frame gap that we just filled, and we're going to go trade back up to a high. And what do you freaking know? That's all that trends are. That is all that trends are. So obviously, you're going to have to identify your draw and liquidity on the higher time frames, but like identifying your draw on like the daily and the weekly is super, super simple. You can literally just pull up the daily chart and look at the chart, and more often than not, if you pick a point in price, as long as you're being logical, you're going to be right, okay? So, like, if you pull up the daily chart right now, I mean, when we were down here, I did want the weekly gap. To me, that just made more sense. But, like, coming into this week and the week before, when we were pushing here, when we're at this candle, it's unbelievably obvious that we're going to go for all-time highs. Like, it's not even a question. You could just look at the chart and be like, okay, we're going for all-time highs. And then if you wanted shorts, when we were down here like I did for the weekly gap, you still would have had winning opportunities using what I'm about to show you, okay? So... you obviously have to start by identifying your higher time frame draw, just overall long term on like a weekly time frame. Where do you want the price to go, or where do you want the market to go, right? Then after that, you're doing what I told you. You're identifying which of the two options are we at? Did we just take a high and need to go and trade into an unfilled high time frame gap, or are we in the unfilled, or are we in the high time frame gap and need to go trade to a high? 1 second. All right, actually, let me start off by showing this before I show the actual candlestick, okay? So, like I said, high time frame gap, or we're taking an external high, okay? So, everyone already knows what a classic trend line looks like, up, down, higher highs and higher lows, right? But the higher lows are typically formed in a higher time frame imbalance. So, what does that mean? That means, for one, you know where the higher low is more than likely going to be put in, so that gives you options. That means you can target it because you know where it's likely to happen, but you also can start to look for longs when it books because you know when it should happen. So that's why my bias is so simple and it's only two easy options. You know what I'm saying? So I just want to rock your world here for a second for people who don't use internal to external. Like that's what the ICT nerds say and what I used to say, but it's realistically just trading to a fair value gap and trading away from a fair value gap. Okay, so you see this, and this is clear, right? It's clear. It's like, oh, you drew a textbook example. There's a fair value gap, and there's a high. It's like, oh, okay, you just drew a textbook example. It's cherry picked, whatever. Okay, check this shit out, bro. I'm about to knock your socks off your rockers. Wait, why didn't it copy the whole thing? There you go. Good boy. Okay, check this shit out, man. Check this out. This is the past 2 weeks of price action. It's getting strange, right? Is that not getting weird? Is that not getting weird? It's getting a little weird. It's getting a little freaky, okay? Now, this is where I'm about to rock your world, okay? Remember, we are either trading from a high to an unfilled gap, or we're trading from an unfilled gap to a high. Oh, here's an unfilled gap. That's weird. Oh, that's even more strange. What happened after we took this high? Oh, we traded back into this unfilled gap. Wait, no. This can't be. We traded from the unfilled gap back to this high. What happened after? This cannot be. It can't be. We traded back into a gap, and with our draw being all-time highs, what did that gap do? It gave us our draw liquidity. There's no way. And then what do we do today? Hold on. We're not even done yet. What did we do today? After taking the high, we traded back into a high time frame gap. You guys, take a guess what trade I took today. Take a guess. I shorted. Why did I short? Because I only have two options every day. It's either we took a high and I trade into an unfilled gap, or we're in the unfilled gap and I long. Like, it's so simple. It's so simple. But that's not the part that's gonna like knock your rockers off. I want you guys to just see like the ideal example that I drew, and then see this. Oh wait, come on, man. Check this out. Look at this next to the textbook example I drew. This is just a normal uptrend, textbook uptrend. And I told you, internal fair value gap, we go and target the external high. This isn't hand drawn. This is literally, I mean, it's hand drawn because I use my hand, but like, this is literally the chart. These are all drawn from the chart. I didn't like place those fair value gaps randomly. This is actually what the chart did. So for the past 2 weeks, you could have either traded from a high time frame gap to a high, or traded from a swept high to an unfilled high time frame gap. And I can even show you with like actually looking at market open. I don't even have to like do any deep analysis, bro. Let's make this nice and simple, okay? Like I said, even if you wanted the weekly gap, which was here, like me, you still could have cut shorts, okay? So we had this move up. Punch was getting into something. Give me a second. Okay, check this out. So market open here, I mean, it traded up into the high time frame gap and equilibrium of this range. So, and it was a Monday, so keep that in mind. So it's a Monday. If you want us to short, you want us to start the week by going up to get, obviously to get manipulation. So being long biased this day would have been fine, just because you're applying the same logic just on a larger scale. So instead of looking at it in the 4 hour, you were targeting the daily gap and equilibrium. You wanted key levels to book to the upside before shorting. So you could have cut the longs here, but if you specifically only want to apply it to the 4 hour, you could have just missed the trade on Monday, okay? And then even if, right, even if you still wanted shorts, even though obviously we ended up long into all-time highs, what did we do here? Okay, here's market open. Market opens right here. So you know that we just pushed up, and the previous day we booked a key level, and there's unfilled high time frame gaps to the downside. Are you going to keep longing, or are you going to, like I said, there's only two options. We either take a high and need to trade to an unfilled high time frame gap, or we're in the gap and we need to trade back to a high. So when you're at market open and you see this, what's the obvious answer? We just took a high or a key level and we need to trade to an unfilled high time frame gap. So market opens and we short into the unfilled high time frame gap and basically do nothing for the rest of the day, right? Now, we get into the next day's market open, which is right here. It's the other scenario. You only have two options. So look at this. Did we just take a high and need to go into an unfilled high time frame gap? Or are we in the unfilled high time frame gap and need to go take a high? Oh, Darius, I think we need to go trade to an unfilled high time frame gap. Fuck you. It's so easy. We're clearly in the gap and need to trade higher. It's easy. This is your draw. This high right here is your draw. That's super simple, right? No previous session liquidity, no daily profiles, no whatever, bro. You're either targeting a gap or you're targeting the high of the range. Okay? But let's keep looking at it throughout the entire move to all-time highs, okay? So now, this day pushed up. This is the next day's market open right here. So when you see this, do you think we're in a high time frame gap and need to go take a high? Or did we just take a high? Take the hint. Or did we just take a high and we need to go trade to an unfilled high time frame gap? It's the latter. We just took a high, we need to trade to an unfilled high time frame gap. This day I only targeted this gap, but this could have been a target as well as an unfilled high time frame gap. But nonetheless, you were targeting an unfilled high time frame gap because we just took a high, right? Now, going into the next day. This day ended up bouncing in PM, so this is where market opened. No, this is where market opened, okay? Market opened right here. Market opened right here. So when you're there at market open, you're looking at the charts. Are you thinking, which of the two scenarios are you thinking? Did we just take a high and need to go trade into an unfilled high time frame gap? Or are we trading from the unfilled high time, or from the high time frame gap? I need to go take a high. We're clearly displacing from the gap that we filled and need to go take this high. And then you literally just do that every day. Like we'll finish this, okay? So now the next day is where? The next day is here. And obviously we're below all-time highs, so if we didn't go for this lower unfilled high time frame gap, that would have been fine. I even attempted along this day just because it's all-time highs. Like all-time highs gets different treatment. But nonetheless, what did we do? We just took a high. So if we don't go get all-time highs and it becomes clear we're not going for all-time highs, what do we need to do? We just took a high, so we need to go take an unfilled high time frame gap. So we trade into the unfilled high time frame gap, form an SMT, and then what does Tuesday do? Is today Tuesday? No, today's Wednesday. What does Tuesday do? Tuesday shoots up, takes previous day's high. And then, even today, after all-time highs, okay, we're clearly overextended. We clearly just took a high. So do you think I'm going to be looking to long this day? No, I'm not going to be looking to long this day. I'm going to be looking to short into an unfilled high time frame gap because we just took a high. It's only one of the two things. Only one of the two things. It makes finding your draw liquidity super easy. So that's why I'm putting so much emphasis on it and so much time on showing you guys this, because I think this is going to be one of the most important things for a lot of newer traders, because finding draw liquidity and finding bias comes off really complicated when it can really be as simple as this. But yeah, now let's go into like finding executions and what I qualify as like my A+ entry. Okay, there's one sentence to keep in mind when it comes into like what I qualify as like an A+ execution. And like I said, this is like a universal application. You can be trading whatever strategy, and if you have this thought process in mind, it'll more than likely increase your trade quality or your trade quality. So this is all I think about when I'm entering a trade and I want it to be A+. If I want shorts, are the highs protected? Is there no more reason to go higher? And is my draw and liquidity lower? Am I really, really confident in it? If you have those two things, you have an A+ entry. It's that simple. Well, maybe I should rephrase it a little bit, because your stop loss also obviously has to be protected. So is the swing, this is all you have to think about when you're in a trade. If I wanted shorts today, which I did, do I feel like these highs are protected and shouldn't be revisited? And then when you enter the trade, the only other thing you have to think about is the draw and liquidity abundantly clear? Is it absolutely perfect, and do I have complete confidence in it? And is my stop loss well protected? That's it. So basically what I'm saying in simple terms is, do I feel like there's no more reason to go higher and every reason to go lower? If the answer is yes, and you believe that with your chest, you're more than likely in a high quality trade, right? Because I mean, what else could you ask for? You feel very confident about where the market's going to go. You feel very confident in the fact that trading in the opposite direction just wouldn't make sense anymore. And your stop loss is a clear invalidation point and it's protected. Okay? That can be applied to, like I said, pretty much any way of trading. So let's go over some examples. I was trading some evals today, and I trade high risk and I add frequently. So I did end up getting spanked, and today tested me. Today tested me. Okay? So see these sets of equal lows we put in here? That was an hourly gap that I was targeting, okay? I just want to get this out of the way before I show you guys some examples of good entries, okay? But I was in on this value gap, okay? I added along the way, and I add heavy as fuck because I'm trying to pass in one trade, and it's alpha account, so it's not just make 4K to pass. It's I have to make 6K 2 days. So 6K is obviously a lot. It's going to take a lot of size, so I scale in along the way so that I'm never really over-risking as much as possible. But yeah, so I'm scaling in heavy as a bit, right? And then, you guys want to guess? You want to guess where my TP was to pass? Do you guys want to take a gander and take a little guess? Right here. Literally right there. If we didn't put in 3 sets of equal lows and went right there, I passed my counts, right? So, yeah. But the market knew I was in the trade, so they were like, hey, absolutely butt fuck this fair value gap just to stop them out real quick and make them like want to like not exist anymore, and then absolutely rip to the TP. So that's what happened today. But I do trade evals like extremely differently than I trade my actual accounts. So I'll show you my original entry on this trade that I'm referring to is like the regular A+ entry. I just wouldn't have added if I was trading like a normal live account because obviously it's aggressive. Poncho! Don't do that, man. He's drinking the toilet water. All right, but let's get into it, okay? So first things first, I want to get out of the way. So what I mean by like believing in the fact that this high or low shouldn't be revisited, or the swing point of your trade shouldn't be revisited, is basically me just saying that it's protected. So there's certain things that make a high or a swing point protected. The main one is normally going to be an SMT. Like if we are in a key level, put in an SMT at the swing point, and my draw and liquidity is in the opposite direction, I'm really confident in it, I'm looking for a trade ASAP, because that's like the absolute best opportunity to take a trade, because in my experience, SMTs create the most protected swing points. Like if we create an SMT at a key level, there's no more key levels higher than the SMT that we should book, and the draw on liquidity is in the opposite direction, and it's a high quality draw on liquidity. Like that's the absolute best opportunity you're gonna get to take a trade. Like that, if it's shorts, that's the absolute most premium that you're gonna be able to catch an entry and have it be high quality. So SMTs are normally when higher low is gonna be protected, and then other than that. But like overall general description of what a protected high or low is, it's just when the swing books a key level and then starts displacing towards your draw. Because that would mean that swing point did what it needed to do, it booked whatever's in the opposite direction. Like I said at the start, you don't think there's anything else that we should logically book before we go to the draw, and we're starting to create PD arrays in between that swing point and where the market currently is. So if you're right about the draw on liquidity, like let's say it's a bearish draw on liquidity, and for example, this high pushed up into a standard deviation level, right? So to the upside, that standard deviation was as high as I wanted us to go. We booked it, and then we started to trade lower and create key levels in between that high, in between this high and wherever the market currently was. Like let's just say we're here. This rally gap's here, this order block's here, this order block's here, this order block's here. There's a lot defending this high, right? Obviously, we ended up pushing higher, but we never ended up revisiting that high. And normally, like the delivery is going to be a lot cleaner than this. I'll show more examples so that you can see the clean delivery. But that's basically what I mean, is in a bearish example, the high books whatever key level that you think that we, like it's the last key level to the upside that you think we should book before we go lower. It books, and then we trade away from it, and we start building PD arrays in between that high and where the market currently is. If you're bearish, this is like common knowledge. You guys know this. If you're bearish PD array should hold. If you're bullish PD array should hold. So if you're bearish, we go up and we book something that's important, and then we start trading towards the draw and creating bearish PD arrays. It only makes sense that the bearish PD array should hold, right? That's basically the whole premise behind like what I view as a protected high or a protected low. But like I said, SMTs are normally going to be like that's when I feel the most protected. That's when I feel the most safe about us not revisiting a high. Okay, so today is actually a pretty good example of that. Here, like I said, this high right here booked a stack of standard deviations. So on the higher time frames, there was like a 1 standard deviation here and like a 1.5 standard deviation here. Those booked. I didn't want us to go much higher than that. And then after those booked, we pushed lower, and then obviously we ended up coming back up. But when we came back up, that was an SMT with ES. ES was remaining extremely bullish and made a higher high, and the higher high was like way above NQ's high. And then this is what I'm saying. So the SMT created the swing point, and then for you to feel like we shouldn't rebook this high, this candle was it. So we booked the SMT at the standard deviations. So at that point, you can feel pretty confident in the fact that this is more than likely where the reversal is going to start, and you can look for entries as soon as possible. Obviously, it's kind of unfortunate that the confirmation of this SMT ended up being like a fat ass candle, because I would prefer to be entering somewhere around the SMT. But this fair value gap is like it's the next best thing. It's the best entry that you're going to get offered after that type of candle. But yeah, so this is like a perfect example of what I just said. We created a very obviously protected high in the form of this SMT and us being at the standard deviation levels that I wanted us to book. And then the draw in the opposite direction is abundantly clear. Abundantly clear. We're super overextended. There's high time frame gaps to the downside. This 4-hour gap was my draw for the day, by the way, which I'm going to show in a bit. But in the short term, we had these stacks of relative equal lows right above the hourly gap. The draw is abundantly clear, and us creating this protected high and displacing from it also even made it even more abundantly clear that that's just where the market wants to go. So we created a protected swing, and we're trading towards a high quality draw on liquidity, a draw on liquidity I'm absurdly confident in. That's an A+ trade. If you're bearish, you expect bearish PD arrays to hold, especially after we create protected highs and we're trading towards a high quality draw on liquidity. That's a textbook example of an A+ trade, okay? We'll go to a different day because I don't think there's any more A+ entries to go to this 4-hour gap, but let's go to a different day. Or we can just full port Asia session. Too easy. But yeah, let's go to a different day. So let's go to yesterday. Yesterday, obvious target, all-time highs. Very, very obvious target, okay? And like I said, you're looking for us to create a protected swing. If you're looking to long, you're looking to long when we create the protected low, and you want to be trading towards a draw in liquidity that you're 100% confident in. Not, I'm iffy today. I feel in between. This could book, but we could also go lower. No, it's like I feel abundantly like I would put my nutsack on the fact that we are going to go book this and then wait for us to create a protected low. It's an A plus trade at that point. That's how I qualify. Okay. So there was 2 examples from yesterday. The first A plus entry didn't end up holding because at this point, at this time, Trump announced he's gonna fire Powell. Like, of course he would do that. But yeah, so this is a perfect example. So remember what I said. Remember what I said. You're looking for if you want a long, your thought process should be, what could we logically book to the downside before we do go book my bullish drawn liquidity? That should always be your thought because that's where you're looking for the protected low to be put in, right? So yesterday's example was equilibrium of this range. I know you guys see data lows and obviously ended up booking later in the day, but something you have to understand is times of volatility, so basically just news drops and market open, we are either going to expand to the draw or it's going to be manipulation. That's all it's ever going to do, right? So if I'm bullish for all-time highs and I see that CPI expands to all-time highs, I'm going to assume that we're not going to trade back below this candle, at least until all-time highs is booked again, because I'm assuming it was an expansion to my draw because the draw was obviously all-time highs, right? So on this day, I don't think we go below this. I've identified a point that we shouldn't deliver below, and there's a high time frame SMT at these lows, so I don't even want us to trade to these lows, right? So just multiple reasons why we shouldn't go lower. So what could we book below where price currently was before market open, which was here? That would make sense. Equilibrium of this range is perfect. We were right next to equilibrium of this range. It would give us room to manipulate before going higher. That's exactly what we did. So we opened up, pushed down into the only place that it was as low as I wanted us to go, equilibrium of this range. I don't want us to book this candle's low. Equilibrium is as low as I want us to go. We open up, push into it, form an SMT, and then get a candle closure back above the manipulation leg. So that's a very clearly protected low. We booked anything that I wanted us to book to the downside, so there's no reason to go lower. And on top of that, we put in an SMT, which is one of my favorite forms of protected lows. So knowing that my draw is all-time highs, I would literally take both of my balls and put them on the table and say, yo, if this TP doesn't hit, take my nuts. And I would feel confident in that, just for all the reasons that I told you, right? So you could have took this fair value gap. I was in earlier because I trade second charts, but you could have took this fair value gap, put stops below the breaker, below the imbalance, targeted all-time highs, had a calm almost 3 risk reward, and then obviously, like I said, Powell gets announced that he might get fired, so you get break-even stops because after we book this gap and then take this high, you 100% should have stops below this wick and you should be trailing. So you would have got a break-even stop. Not a big deal because it's an A+ setup. Why is it an A+ setup? There's no reason to go lower. We created a protected low, and you're targeting a high confidence draw liquidity. It's A+. And this is another thing too. I feel like you guys stress entry models super hard. Like I said, like I've been saying this entire time, you are gonna, if you're bullish, you should expect bullish PD rates to hold. So if we just created a protected low, meaning we should not revisit this low, in what world does this fair value gap not hold? It's not that complicated. Take the fair value gap because it should hold. We're bullish, right? It's really not that complicated, bro. But anyways, that's the first example from today. Even though this didn't hit, this was A+, 0 questions asked. And then a lot of people started to get bearish. A lot of people didn't even know that Powell got announced that he could get fired. But a lot of people got bearish after we had this dump. I didn't. I just want you to know he's barking at nothing. There's not a shadow. A light didn't flash. There's no noise. He is just schizophrenic, and he does this all day. I slept 3 hours last night because he kept waking up and barking. Anyways, a lot of people got bearish here. I didn't because, like I said, there's 2 steps to having an A+ setup. I need to be abundantly certain that we are going to go book this draw. I was abundantly certain that we were going to book all-time highs. There's no way we're going to leave without booking all-time highs, right? And then you need a protected low. So even though this isn't the immediate swing point that I'm looking to be protected, I know that these lows are protected because of the high time frame S&P that is there. So that alone already makes me not want us to go lower than where we were when we were at this point. But another thing too is we put in another SMT with a key level or a key like low, which is data lows. So we have an SMT currently with data lows. NQ took them, ES didn't, right? So knowing that I'm so confident in my draw, seeing that there's this SMT is there, I'm willing to long as it stays intact because that my idea is still valid. We still have a protected low. The only other low that's below where price currently was at this point is a low that's also protected by the high time frame SMT that formed in a high time frame gap. So I still have the things that I want. We just obviously got a move that wasn't preferable. But I'm still open to it if I feel confident in it, right? So that SMT forms. Not only is this low protected by the SMT, this low is protected by a high time frame SMT. So there's like a heavy confidence in the fact that we shouldn't go lower and we should go push to all-time highs, right? So this is the first confirmation that we get coming out of that SMT, which is this fair value gap not holding. I take that. 0 questions asked. I'm gonna take that. Take it. Put stops below this wick because this is the last imbalance in the price leg right here. So, like I said, if you're bullish, if we were truly bullish and I was right about us being bullish to all-time highs, this fair value gap should hold. Why? Because when you're bullish Peter rays hold and bearish Peter rays fail. So I just watched a bearish Peter ray fail after we created a protected swing point. I'm going to expect the bullish Peter ray to hold, right? So I put my stops below the invalidation point of the fair value gap and I just let the trade rip, bro. I was on evals on this day. This is my max daily profit was like right here, but 0 questions asked. I was holding for all-time highs if that wasn't the case. Why is this A plus? I'm gonna repeat it one more time. The same as every trade I've shown you so far. Why is this trade A plus? I had a draw that I would put my nuts on. That's not the way I want to phrase that. I had a draw that I would bet my nutsack on. I would give up my nutsack and say, yo, take these if this draw doesn't hit. That's how confident I was about it. And then we also created a protected swing point below my entry. In simple terms, meaning we shouldn't go lower. There's no reason to go lower and every reason to go higher. Those are the trades you want to be in. You don't want to feel iffy about one of those 2 steps. And both of those steps you need to feel undeniable about. You should feel undeniable in the fact that we just created a protected low and there's no reason to go lower. You should feel undeniable in the fact that your bullish draw is like you would literally bet your life on the fact that it would book. If you feel that confident in both of those steps, every trade, you are taking an A plus trade. So yeah, that's it for the technical side of things. Let's talk about the psychological side of things. Okay. All right, man. The psychological side of things, one of these things is going to be funded account specific. The other one's just going to be general. Funded account specific, this is a part that like you hear a lot on TikTok, but I don't think you guys really understand it and internalize it. Probably just because like you guys haven't gotten to the point where like you're getting payouts and whatnot. But the difference between real trading, like on a live broker, and trading on a funded account is that funded account trading is a legitimate business, right? Regular trading on a live broker is not a business. There's no operations to it. Funded accounts are. You have revenue, you have expenses. So you have to look at it that way. Like trading on a funded account is not normal trading. You're not even a real trader if you trade funded on funded accounts. Obviously, you have to have a skill set and you still have to be good at trading, but you're not a real trader on funded accounts just because of the way that it's set up. But that's in your guys' favor because you don't have to be the best trader ever. You don't have to be you don't have to be absurdly good. You don't have to have absurdly good risk management. You could fuck around and get lucky and take a payout. I've had stretches of time where I've traded like horse manure and I've gotten like back-to-back payouts, trading like garbage, bro. That's just how it's set up. Especially when you're past the buffer, bro. You could trade like, bro, even on like this month I just showed you, one of my sets of payouts, the first day after my buffer, I broke my risk management rules and I lost like half of my buffer, right? And then after that, of course, I kept trading because I have an ego and I believe in my draw. And then I made it all back and I locked in a 20K payout or like a 15K payout. That's not good. That's not good trading. That's not good trading practice. But because of the structure of how funded accounts are, I still put 20 racks in my pocket. Like I said, That's still in your guys' favor, and I'm just trying to drill into your head that this isn't like, not that you shouldn't take it as serious, but when it comes down to it, all that matters when you trade funded accounts is your payouts need to be more than how much you're spending on funded accounts. That is the majority of what funded account trading is. I know some really, I mean, not bad traders, obviously they get paid, but traders who probably aren't even as good as you, probably not even as good as you watching this, making 5 figures a month, trading prop firms. Because they understand it's a game. It's a numbers game, bro. But the point of this and the reason why I'm saying this is like a psychological tip is because what's gonna happen with a lot of you guys is you're gonna take the stuff I just showed you or some stuff you already know, and you're gonna finally make it to your first payout. And you're gonna think like, okay, this is it. I've made it. I'm just gonna take payouts from this funded account every week. Life's good. And then what's realistically gonna happen is after you take your first payout, you're gonna blow the live account and you're gonna be sitting there and you're gonna be like, bro, what did I just do? I hate my life. It's over. Oh my God. Gang. I've probably blown more live accounts than funded accounts you've bought. Does it matter? No, because my payouts are way more than I've spent on funded accounts. It literally doesn't matter to me. I just lost a set of live accounts. Do you guys think I care? Oh no, my XFAs are gone. What am I gonna do? Those XFAs gave me 65 racks, and I spent like 2K on it. That's what I'm saying, bro. If as long as you are getting payouts, the only time you should feel concerned is when your expenses are extremely exceeding your payouts. Because obviously, when you first start getting payouts, like the difference between the amount that you're spending and the amount that you're making probably isn't going to be super drastic. But once you get any type of consistency, it's going to be a drastic difference because of the ROI that fundeds give. So if you lose a live account, if you lose an eval, 1 or 2 evals before you pass one, that's not something to be stressed about because your payout size will extremely outperform whatever or be like a way bigger number than what you're spending. Like, let's just throw a number example out there. Let's say you're buying 150K accounts, okay? Let's say you're buying one 150K account. They cost 150 a piece and 300 all in if you get the activation, okay? So let's say, bro, we're gonna go extreme on them. Let's say you blow the account 5 times in a row. You're not gonna do that, by the way. Like if you're actually sitting here and you're trying and you're using good risk management and you're taking only A+ setups, and you have a skill set, obviously this applies to having a skill set. You have to have a skill set in order to actually make money from funded accounts. It's just what it is. You have to have some sort of baseline. But imagine you blow 500 accounts, right? What's 5 times 150? Oh, I shouldn't have done this, bro. I'm not good at math. $750, okay? You spent $750 dollars on funded accounts, and let's say you passed the 5th one, okay? So now your total buy-in is $900. It took you 4 failed funded accounts to pass the 5th one, and to activate it, you're $900 in. Do you understand that $1,000 isn't even a 1% payout on a singular 150K account? The ROI on funded is ridiculous, bro. It's ridiculous. You don't, as long as you know that you do have a profitable strategy, you don't have to trip over blowing some evals before you pass, or if you blow a live account, or if you get a payout and then you blow a live account. Because as long as you are actually getting payouts, because like I said, you have to have a profitable strategy in order to get it done, your payouts will drastically, like they'll be so much bigger than whatever you're spending. Like the example I just gave you is extreme, bro. It took you 5 funded accounts, and like I said, that's less than a 1% payout. So if you take one payout at 1%, which is small, like majority of the time your payout's gonna be bigger than that, but let's just say you took a 1% payout, you still made a $600 profit. And this is like obviously not a worst case scenario, because worst case scenario is that you never make it to a payout. But like worst case scenario for a realistic scenario where you do make it to a payout. That's what this is. Failing 500 accounts before you get moved to live is a lot. That's like you're just not trading well at the time. And then taking a 1% payout is like probably the smallest payout you'll take. So taking the worst ends of both things, you still end up with a $600 profit. The ROI is ridiculous, bro. Don't trip whenever things don't go your way, because you have to stay locked in order to actually get the ROI from these funded accounts. Because if you do start crashing out and you let your mental slip, that's when things can get bad, because yeah, the ROI is crazy, but if you start crashing out and you start blowing like 10 to 15 funded accounts before you get a payout, that's when it's going to start to get hard to actually grow and make this something sustainable for yourself. So point of this was don't trip over the negative things that come from trading funded accounts, because the ROI is so ridiculous, and getting to the point where you can take advantage of that ROI isn't like a super hard thing to do. That's my main point with this. All right, and then the last psychology thing I want to talk about, it is kind of more heavily related towards fundeds, but I feel like it can be applied pretty generally. It's something that you guys hear frequently, is like with trading, bro, you just can't force results. You can't force things out of the marketplace. Like, obviously, you can back test a lot, you can analyze the charts a lot, you can get a lot of screen time, and that'll make you better. But like, if things haven't been going your way, like, obviously you start off unprofitable. You start off losing money, losing funded accounts, right? So let's just say you're in the hole $1,000. That doesn't mean that you have to go buy more accounts so that you can make the money back faster. That doesn't mean that you have to come on the charts and put more leverage on so that you can make back that money faster. More often than not, it's gonna have the opposite effect that you think it is. This is the reason why I say this, is because I feel like this is something that held me back for a really long time, because I started off by losing a lot of money, bro. Like, a lot of money, because back in my day, the futures funded accounts, they either didn't exist or they just weren't popular. So you were trading CFD funded accounts, and they were expensive, bro. You guys are able to buy a 150K funded account for $150, bro. 150K funded account. Well, we didn't have 150Ks. We had 100Ks and 200Ks. A 200K funded account costs $1,000, and that's before you even pass, bro. So $1,000 up front, and I was the type of guy. This is exactly the point that I'm trying to make, though, is that you can't force results out of the marketplace. So if you keep trying to put more risk on, and like for me, it was in the form of buying bigger funded accounts than I was ready for, or even trading funded accounts in general before I was ready for them, you're going to lose more than you need to before you start making money. And that alone is going to have a psychological effect on you. So, like, I'll go back to my example that I was talking about. So, obviously, I wasn't ready. I should have been demo trading still. But every time I bought a funded account, it was never less than a 50K, and 50Ks cost $500. So I was never spending less than 500, and normally I was buying 200Ks, bro. I was emptying my paychecks. I was emptying my bank account to buy these accounts, because after I lost my first account, the first thing I think is like, bro, like, I can't believe I just lost that amount of money. Like, I really need to get that back. So then what do? The fastest way to get that back is to obviously get the biggest account, because I can make less profit and put more money in my pockets. So fuck it. Let's go from a 50K to a 200K, bro. If I make 1% of 200K, that's $2,000. That's how much I'm making a month. Let's rip it, right? I wasn't ready for it. So obviously I lost that money, but now the more that goes into my loss pile, the more that I think I need to make, or the quicker that I feel like I need to make it back. And obviously quickness in trading implies more leverage. That's the only way that you can make money back quicker. That's obvious math. But like I said, you can't force shit out of the market, and if you try to, you're just gonna lose money quicker, because the reality is, if you're losing a lot, it's just because you suck. So if you suck and your thought process is, okay, I really need to make this back, bro, but this time it's gonna be different. It's like the past 5 funded accounts that I lost, it's not because I suck or because I did anything wrong. Things just didn't go my way. So let's go ahead and buy double the account size that I've been buying and spend $1,000. Let's just do it, bro, because if it goes my way, I can make up these losses really quickly. I won't have to wait months and months and months. That thought process is going to fuck you, bro. And that's why a lot of people quit. They lose too much and they can't justify it anymore. If you just take your time and understand that trying to force stuff out of the market, it creates a higher risk scenario. Because here's really what the thought process is. You guys are only thinking about the upside. So when you think, like, let's use current accounts that people use as an example. Let's say you buy 50K funded accounts and you've failed 3 of them. Just because you're a newer trader, you're not ready, you're just not performing well because you're not ready, you're not profitable yet, right? So you lose those accounts, and your thought process is, okay, like, I lost this money, but I can make it back a lot quicker if I get a bigger account. So let me go get 150K. That's obviously more risk. Those accounts cost triple the accounts that you have been buying. So you're putting more risk on, and the only thing that you're thinking about is the upside. Your thought process is, okay, if I have a bigger account, I have more leverage, my upside potential is higher. I can make more money, I can make back these losses, and we can finally move forward. But what you're not thinking about is, in order to increase your upside, you are increasing your downside as well. You will lose more if you lose, and because you still suck, the odds of you getting the downside are higher than you getting the upside. And you're going to keep repeating that process and only to keep digging the hole deeper and deeper and deeper and at a more exponential rate because you keep trying to add more risk onto your scenario to make the money back quicker instead of just doing it. What if instead of thinking about how much you've lost, thinking about the time frame that you want to do it, what if you just did it? What do you think that would do for you, bro? What if instead of thinking I want my first payout within the first 6 months of trading, what if you just thought about doing it, just accomplishing it in general? It would take a lot of these like negative and self-inflicting thoughts away. You wouldn't think about, oh, I need to get a bigger funded account to get my first payout quicker or to make my first $10,000 quicker. It wouldn't even be a thought in your mind because if you're just thinking about, okay, this is my goal, I'm just gonna accomplish it. I'm gonna do whatever is needed. If it takes this amount of time, it's gonna take this amount of time. I'm just gonna do the right things. I'm gonna do what's needed to get it done. You're not gonna think about these like dumb decisions, bro. Because trading without the right brain and without the right strategy, it is gambling. It really is, bro. So your job is to limit that and to stay within the space of it. I mean, realistically, being a profitable trader is just well-controlled gambling, bro. You want to be in that space. But yeah, man. I mean, this video is getting pretty long, but I think what I said is pretty important. Poncho is trying to do something. Don't ask me. But yeah, I think what I said is pretty important, so I don't mind if this video is long. If you mind that it's long, I think I said this earlier, but I'll say it again. Okay? But yeah, man. I mean, I hope you guys really took this to heart. I know you guys got TikTok brain, but I hope you guys take this stuff to heart because I feel like this can help a lot of you guys. But I'm going to get out of here. Bye. Well, actually, tonight, remember this face when your eyes are closed. And remember my nips, too. Bye. See you later. Poncho, get off me!